Hi, Assalamualaikum and good day everyone. Today I will presenting our film 357 Corporate Finance Report of the Merger and Acquisition, Big Company Pharmacy and Caring Pharmacy. In this presentation, I will explain the type of merger and acquisition. Why this merger is classified as a horizontal merger, the reason behind the merger, and its financial impact of the company. Let's begin the type of M&A. This slide explains two common types of merger and acquisition, which are horizontal merger and vertical merger. First, a horizontal merger occurs when two companies operating in the same industry and at the same stage of the value chain combine. The main objectives are to increase market share, reduce competition, achieve economy of scale, and strengthen their market position. A real-world example is the merger between Big Pharmacy and Caring Pharmacy. Both companies were leading retail pharmacy in Malaysia, selling similar healthcare products and serving the same customer market. Since they operate in the same industry and at the retail level, this merger is classified as a horizontal merger. Through the merger, they form Malaysia's largest healthcare retailer with a wider network of outlets nationwide. The combined company also benefit from bulk purchasing, lower operating costs, improved operational efficiency, and stronger bargaining power when negotiation with suppliers. Secondly, vertical merger. Vertical merger occurs when a company at different stages of the supply chain merge. For example, a manufacturer may acquire its distributor to gain better control over production and distribution. An example is CVS Health acquisition of CareMed in 2007, where a retail pharmacy merged with a pharmacy benefit manager. This allows the company to improve supply chain efficiency, reduce costs, and provide more integrated healthcare service. In conclusion, the Big Pharmacy and Caring Pharmacy merger is a horizontal merger because both companies were direct competitors operating in the same retail pharmacy industry, making this the most suitable type of M&A for our case study. So next, I will explain two other types of merger and acquisition. Firstly, corporate merger. This type of merger happen when two companies from completely different industry combine. The main purpose is to diversify the business and reduce it by entering new market. A good example is Berkshire Hathaway and Duracell in 2016. Berkshire Hathaway is an investment and insurance company, while Duracell is a battery manufacturer. Since they operate in different industry, this merger helped Berkshire diversify its portfolio and generate income from new business sector. Another is market extension merger and acquisition. This happens when two companies sell similar product but operate in different geographic market. The goal is to expand into new region and reach more customers without changing their product. For example, Burger King and Tim Hortons in 2014. Burger King was strong in the United States, while Tim Hortons was leading brand in Canada. By merging, both companies expand their market presence across North America and internationally while keeping their own brand and product. In summary, corporate merger focus on business diversification, while market extension merger focus on expanding into new market, into geographic market. Thank you. Let's look at our first merger or acquisition, or the last one. Is the product extension merger. This happens when company selling related but not identical product combine. So the merged company can offer a broader, more complete product portfolio. A great real-world example is PepsiCo acquisition of Quaker Oat 2001. PepsiCo was a beverage company and Quaker Oat made cereal. These products are related consumer goods sold through similar retail channel, but they were not directly competing with each other. This result, PepsiCo end up with a broader complementary snack and beverage portfolio and stronger shelf presence with retailer. Next, we continue with about which merger type apply to big pharmacy and caring pharmacy. The answer is horizontal merger. Not product extension. Why? Because both companies were in the same industry. Retail pharmacy and healthcare chain here in Malaysia, they were at the same value chain level, meaning they were direct competitor, not a seller and buyer relationship. The outcome was that they combined into Malaysia's largest healthcare retail group, gaining scale, procurement power and market leadership. So the key distinction to remember, product extension merger combine related but different product to broaden offering, while horizontal merger combine directly competitor in the same consideration to gain scale and market power.
And now to the main reason of merger and acquisition of big caring pharmacy. Before the merger between those companies happened, Malaysian retail pharmacy was highly fragmented. For decades, an independent pharmacy or a pharmacy that runs by family dominated the local market. Only a small percentage of the retail pharmacy market was organized by the professional corporate chains. Because of this, most independent stores compete with each other and engage with the price-cutting war, which result price undercutting. With both big pharmacy and caring pharmacy expanding, they were fighting over the same market share and restore the profit margin across the industries. So by acquiring the caring pharmacy and the newly formed big caring group captured an estimate 23.6% market share in the retail of Malaysian pharmacy industries. Besides that, with those two companies merged, they operate for almost 626 outlets that made it impossible for small independent pharmacies or new corporations to compete. Then, when the fragmented competition is eliminated, their companies gain price setting power, which is rather than lowering the price, they can maintain the standardized and optimized retail price across all the outlets. Then for the second one, supercharging the economic scale. Before the merger happened, big and caring pharmacies separately negotiate with the global giants such as Pfizer, AstraZeneca, GSK, and local distributors. The pharmaceutical use tiered price structure, which is the more you buy, the lower cost per unit. So by combining the companies, they can put a massive order on or unprecedented bulk orders and supply it to over 600 stores. This grant them a absolute lowest tier of pricing along with the volume rebates and credit terms. Besides that, economies of scale does not apply in the buying products but also how they run the business infrastructure. Before the merger, both companies had to spend so much to maintain the independent headquarters, separate HR department, individual marketing teams, and so on. It shows that the company can cut or lower the operating cost and allow the revenue to flow as net profit. Then we move to the geographical and brand strategy. When two retail chains merge, they might have to face cannibalization because the stores are too close to each other and they might steal the customers. However, big and caring pharmacy had their own strengths in geography, where most caring pharmacy operated in the premium shopping malls and high-density commercial hubs like the LCC, Mid-Valley, IOI, and major AO malls. Furthermore, through its prior acquisition of Georgetown Pharmacy, caring pharmacy dominates the northern region of Peninsula of Malaysia. Then Big Pharmacy was started as a community pharmacy where they dominated the suburban neighborhoods, shop lots, and the southern region. It shows that instead of overlapping, they expand their business nationwide by combining the companies. Besides that, instead of erasing the Caring brand, they changed the store to the Big Pharmacy, where they strategically keep both alive because of different segmentation in the market. The current brand brings a strong brand equity among middle to high income shoppers, mall goers, and urban professionals. They also focus heavily on skincare, supplements, beauty products, and mother and baby care. While the Big Pharmacist brand's equity is among the elderly patients, families, or chronic disease sufferers who require affordable medicines. And lastly, upstream integration and manufacturing. Big Caring Pharmacy wants to enter the manufacturing industry through acquisition of an equity interest in Yanling Holdings. Basically, this Yanling is a PICS certified manufacturer with over 30 years of experience. They manufacture more than 800 registered drugs. supplements and herbal products. By absorbing the Yanli holdings to their companies, they can become the only major or key players who control the manufacturing chains in Malaysia. They also control all the process from factory formulation all the way to the retail cash. Besides that, when the Malaysian market face a shortage in import medicines, they can use the Yanlin to make substitute medicines under their own brand, so they can fulfill their market segmentation. Relying on the external suppliers means the pharmacies can only sell what they have because they get a million customers monthly. They possess real-time data on what health items that are trendy and instead direct their upstream manufacturer to formulate, customize and produce specific products that match local consumers' demand. Now we move to the next part, which is financial ratio. Before the merger happened, the company current ratio is 1.003, which means that big pharmacy companies was in safe position and barely covering their short-term liabilities. Following the merger between big and caring pharmacies, their current ratio is slightly decreased to 0.99, where there is a risk of working capital constraint or immediate liquidity risk. For the quick ratio, before the merger, their company ratio is 0.12. It shows that a massive portion of the company assets is tied up with the inventory, leaving them exposed if cash is needed immediately. After the merger happened, their quick ratio increased slightly to 0.41. That means the company immediate cash is in good positions. Then we move to the profitability ratio. First, we got gross profit margin. Before the merger, the gross profit margin is at 20.9%, while after the merger is at 24.7%. The gross profit margin has improved significantly by 3.8%. This means that the merger is benefiting from the economies of scale. Then we move to the net profit margin. Before the merger, the net profit margin is 3.71%, and after the merger happens is at 4.90%. Even though it looked like a positive increase, the growth here is smaller than the gross profit. This indicates that company's production become cheaper and the company are likely to face high merger integration costs, increase in interest expense and administrative overhead. Then return on asset. Unlike the ratios in the profitability margin, the company's ROA has slightly changed from 5.66% to 4.51%, which is 1.15% decrease. While the company is making net profit, they also does not utilize the asset efficiently, so that the management need to focus on the operations while utilizing their assets so that the ROA can back up to the levels before the mergers happen.
So for next part, we'll talk about activity ratio. The first one is to analyze the total asset turnover ratio. We look at how efficiently the company used its asset to generate revenue. This ratio decreased from 1.53 in 2023 to 1.08 in 2025, which warrants a closer look at the operational strategy. Second, for the fixed asset turnover, it increased significantly from approximately 9.29 in 2023 to 14.09 in 2025, indicating that the company has become more efficient at generate revenue for every unit for currency investing in property, plant and equipment. And also the day sales outstanding remain relatively stable, moving slightly from approximately 15.42 days in 2023 to 15.62 days in 2025. This indicates consistent efficiency in the company's accounts receivable collection process over the 2-year period. Next is liquidity ratio. We have two ratios, which is current ratio and cash ratio. The current ratio for both years is approximate 1.00, suggesting that the company's current assets are almost exactly equal to its current liabilities, indicating a tight liquidity position. The cash ratio improved from approximately 0.09 in 2023
to 0.25 in 2025. While this indicates that the company has increased its relative liquidity in terms of immediate cash, it remains low, meaning the company relief on other current assets like inventory and receivables to meet its short-term obligation. And the last ratio is about market ratio. Here we have price to earning and market to book. A price to earning ratio is best used when compared to industry peers or the company's historical average. As a potential IPO, the valuation often incorporates market expectations for future growth rather than just past performance. The next one is end market to book ratio of 22.72 is very high, which is common for growth-oriented retail companies where investors place a high premium on intangible assets like brand reputation and market reach that are not fully captured by book value on the balance sheet.
Hi, good day everyone. In this session, we discuss the impact of the financial ratio following the merger between Peak Pharmacy and Caring Pharmacy. Specifically, we are going to evaluate whether its ratio movement component before and after the merger reflect a positive or negative impact on the newly formed group. Okay, firstly, we talk about liquidity ratio. We look at three: the current ratio, quick ratio, and cash ratio. The current ratio actually slipped slightly from 1.003 before the merger to 0.99 after the merger, meaning current liability not technically exceed current asset. This is a mild signal of short-term solvency pressure. However, both the quick ratio and cash ratio improves meaningfully. Quick ratio from 0.12 to 0.42 and cash ratio from 0.09 to 0.25. This tells us the company is holding more real cash and near asset and relying less on selling inventory to cover its obligation. So overall, this is not mean, but it's an area where the company should keep a close eyes on working capital management going forward. Okay, so for the next session is profitability ratio. Gross profit margin improved from 20.9% to 24.7%, a jump of 3.8 percentage point. This is the clearest evidence that the major cost strategy, economy of scale in procurement is generally working. Net profit margin also improved but only slightly, 3.71% to 4.19%. The gap between the gross and net margin improvement tells us that integration costs, higher interest expense, and administrative overhead are also been most of the operation again. Return on asset or ROA actually declined from 5.66% to 4.51%. This happened because the asset base inflated by goodwill and acquired property, plant and equipment from the acquisition grew faster than net profit. This is a very typical pattern in the first 1-2 years after a large M&A transaction. Moving to efficiency ratio, fixed asset turnover jumped sharply from 9.26 to 14.09. This shows the group is generating SYAZMEER revenue from the same physical infrastructure. Exactly what we expect from a horizontal merger where most stores are now served by shared resources. However, total asset turnover actually fell from 1.53 to 1.21. This drag likely comes from goodwill and other intangible assets on the balance sheet, which do not directly generate revenue. They say outstanding stay roughly flat, 15.42 days before and 15.62 days after, showing that the account receivable collection process remains stable throughout the integration. For last ratio is market ratio. We look at price to earning and market to book. Unlike the other category, we do not have a before figure here because neither company was separately listed at the time of the deal. So this is not really direct before and after corporation. Both ratio come up quite high. A P-E of 81.81 and a market to book of 27.72. This reflects investor pricing in future growth and brand value ahead of the group pen IPO rather than current earnings alone. So we should read this as context for a growth stage retailer approaching an IPO, not as a verdict major source of failure. Overall, so to break up this section, the merger clearly delivered on its strategic promise of scale and margin expansion. We saw that in the gross profit margin and fixed asset turnover, but it's not yet translated fully into bottom line efficiency or a stronger liquidity position, as shown by the decline in ROA, total asset turnover, and the current ratio. This pattern is completely normal and expected during the early integration phase of a large horizontal merger. In short, the operating synergy are showing up first, where the integration cost and balance sheet dilution from the acquisition are still working through the financial statement. Thank you.